we are live recording. Thanks for making it. Like I said, we're just going to go through a pitch deck for a public 506C deal. 506Cs are deals that the SEC, Securities and Exchange Commission, allow you to advertise. So we have some deals that are private that we're not allowed to advertise, but since we're recording this meeting, we're going to use a public one. And this is a real deal that's actively raising capital right now. Our club did look at it. I like the deal. So we're going to go through it. The reason we're not raising for it is because it's for accredited investors only, and we don't have enough accredited investors in the club to do a 506C deal. And because we're working on a private one, a 506B, we're really focusing on that. This deal made a perfect example because we do like it. It is a good deal. And so we can kind of go through and show you why. It's like what the returns mean, how you vet the team, how you believe any of the pretty advertising, how you research and validate their claims. This one is specifically for multifamily. And these pitch decks are just created in PowerPoint. Usually they'll start out with a disclosure statement or statement of confidentiality for a 506B deal. And 506 is just a section of the SEC code that governs how we can raise capital to put into deals, raising capital from people who are not full partners, people who are limited partners, and they're just going to put their money in and they have no voting, no decision making, but they also have no liability for the debt and no legal liability. They're really limited partners. So there are just a lot of rules when you're bringing limited partners in. So section 506 refers to the types of deals that we can do. A 506B is a private deal that can allow accredited and non-accredited investors, but you cannot advertise it. Accredited just means you have a net worth of $1 million or more, not including your personal home, or you make either $200,000 or $300,000 a year if you're married or filing singly. Once you understand whether or not you're accredited, if you are accredited, you can get into a lot more deals because these 506C deals, we can advertise them and they're a lot easier to find. Problem is with the 506Bs, if you're not accredited, you have to know that operator in advance or find out about it through word of mouth. And so it's kind of like a hush-hush secret. 506C is what really blew the lid off of these private placements back when it was changed in the mid-2000s that we could advertise deals. But the caveat to that was that it could only take accredited investors. And so this is really what opened up the world of syndication for normal people. And it's one of the reasons we've seen commercial real estate prices going up, because there are just a lot more people in the market for it. You don't have to be anybody special. You don't have to be an ultra high net worth individual or have a lot of rich friends. You can just put together groups of people. And when they changed this, a lot of people just got wind of it and started structuring deals this way. So you're going to see a lot of these if you know where to look. This one says it's for accredited investors only, and that we're not supposed to share it. This one you can share because it's 506C, but most of the 506Bs, they need to be spread through word of mouth only. So they're going to start out with a team, which I like because the most important part of any deal is the team. Most pitch decks, the team is usually down a little bit lower, but this group obviously understands that the team and who's running the deal is more important than where the deal is and even the property itself. People who are experienced are going to give you a couple of things. One, they're going to find good deals because they know what they're doing, and brokers and owners are going to bring them opportunities that then they can bring to you. They also know how to recognize a good deal because they're experienced. So they're going to underwrite it. They're going to do proper due diligence. They just know what they're doing. And so by the time the deal ever comes to you from an experienced team, kind of know that they know what they're doing and they're not going to deliver you a bunch of garbage. Now, this is very similar to a pitch deck that you're going to see from a broker who is trying to sell you a property. And oftentimes those are just really bad deals. They just don't pencil. They're priced really, really high. And they're giving you numbers based on, hey, here's what you could do with it. They're not actually giving you the numbers of the deal itself. And so oftentimes when I'm going through broker decks, trying to find a good deal, they look very similar to this, but these tend to be better when they're actively raising capital for it, because if they're an experienced team, they've already put it under contract, they've already vetted it out, they've already done their due diligence, they already know if it's going to be a good deal or not. So these 4 lead sponsors here, they work for Fairwinds Capital right here. That is this group. Now, usually on the second and third page are capital raisers, people who are maybe signing on the loan. They may even put their property manager on there, their attorney, to show you that they have a great team around them. But these guys are the ones that you care about. The capital raisers typically will raise capital and then they just monitor the deal enough to protect their investors' money. So they will sit on asset management meetings, they will monitor things, but they tend to be either less experienced or capital raising specialists who have been on a lot of deals. They really know what they're doing, but they're not the kind of people who are going to vet it out. They're not going to run the thing. If the person that you know is farther down the deck, that's fine. It's fine to do business with beginners as long as they have experienced partners. These people know what they're doing. There are a couple ways you can do that. You can talk to these guys. How did they find them? Why do they like them? If they do list their property manager or their attorney there, call them and ask if they've ever done any business before. You might ask some questions to get their birthdays or home addresses, especially if they have a normal name, a name you're going to see every day. Running a background check on that would be hard. But if they have a really unique name, go ahead and just pay $40 to run a background check on each one of them, or at least the asset manager and maybe the guy who's doing the finances. If you're going to put the minimum, which is usually like $50,000 into one of these deals, don't step over $40 background checks. If you're going to put $50,000 in a project, go spend maybe a couple $100, maybe budget yourself a couple $100 the first time you're vetting out a new team, and figure out who these guys are. Do they know what they're doing? Do they have criminal background histories? You can run a securities violation check on them for free on the SEC.gov website. Do some due diligence, talk to them. If you can, go meet them in person before the first time you invest with them. That's never a bad idea. I don't think it's necessary, but you're going to get a good gut feel if they're honest, because especially if you know something about reading body language, certainly have a video call, not just a phone call, and just get to know them. See if you want to throw 50 grand at them. If you have worked with them a couple of times before, you don't have to vet them out again. And so most people will find a stable of 10 to 12 operators that they just invest in everything that they bring along when they have money for it, as long as it's in their wheelhouse. Like these guys are multifamily, but if they brought me out new development or self-storage, I'd have to go back and be like, hey, what are you guys doing? Who's on your team that knows how to do this? So as long as they're kind of giving you the same consistent deals over and over again, you only have to vet them out once or twice. That's why the team is the most important part. So we're going to move on to, they're going to give a couple of highlight pages. Typically, they're going to give you just the high level numbers, and then they're going to show you how great the market is. And then very last, they're going to show you how great the deal is, the actual property. And then you may have an appendix with some financials, how to invest, things like that. It's important to have these first couple of pages that you're going to look at these real quick and think, is this even the kind of deal that I want to invest in? Now, if you've invested with these guys before, and you know they send you multifamily, just check that it's the same thing that they usually do. Because if it's not, like I said, you have to do a little bit of extra work to go back and re-verify if this team can handle that different kind of project. But if it's your first time working with them and you haven't vetted them out yet, this is the first time opening the deck, just make sure it's the kind of property that you want to be in. So the first page will usually tell you it's a 208 unit value add opportunity, which means it's existing. It's not new construction. It shows you a nice photo. It looks like they have done some value adds on this already, because I can tell that these are updated railings. The building looks like 1980s construction. The photos can actually tell you a lot. And you're going to look at this right here. This 34 years of combined experience should really be just the main sponsors. None of these should include the capital raisers or even the key partner. The key partner is the one who signs on the loan. He basically has the experience to do it. If things go wrong, he has the right to step in and take over management. So they may sometimes include his experience here, but if it's a brand new team and the most experienced person on the team is the guy signing on the loan, sometimes it can make it look like they have more experience than they actually do. So you do need to verify who is being included in this 34 years or 46 years or 9 active syndications. This is a big one here, 2 full cycle deals. If they've only been in business for 2 years and they say they've had 7 deals go full cycle, then you know there's something fishy there. They're probably including deals from other people on the team, the capital raisers or the key partner. This is part of your due diligence. Don't just see that, oh yeah, they've done 34 years of combined. They have 125 units full cycle. They've got 400 units under management. Who on the team are these numbers describing? And you just have to ask, you know, and if they're hiding things from you, that's why video calls are really helpful, because you can kind of watch their body language. You hear all the, well, you know, it's the combined experience of, you know, and you can see when they're kind of hedging. So that gut feel is very, very important. The next thing you're going to look at is, this is the deal itself. Again, they'll cover the deal farther down, but what they're going to do here is they're just going to give you a quick, brief overview so that you can know what you're looking at very quickly. And if this is not the kind of deal that you want to invest in, this page will allow you to discard it very quickly if it's just not worth your time. These are the anticipated numbers. If they don't really meet your needs, then you can look at this real quick and be like, nah, we're moving on, right? Unless it's a team you really love and you've invested with them before. I want to go through all of these items here one by one and explain what they are, because a lot of times this deal highlights, people will look at it, it's supposed to be the deal at a glance, but if you don't know what these things mean, this is just a bunch of mumbo jumbo on here. So I'm just going to take each of these tiles one by one and explain what they are. Now, there are other metrics besides these that you can use to determine if you want to do an investment or not, and that will typically be down farther in the financials page. Everybody's going to put different highlights on here. They're going to show the good parts and they're going to gloss over the bad parts. So 7.25 million total raise needs to be done by July of 2022. I hear they're just about done with that. The reason that this is important is because you need to know, especially if you're helping them to raise capital, or if you want to partner with them on the general partner side instead of the limited partner, how much capital do they need to raise? The other thing that this is important is because sometimes I'll see deals where groups need to raise, say, $4 million. And I say, how much have you raised? And they're like, well, we need to raise $4 million, which means they've raised zero. So their likelihood of being able to close that deal is kind of low. So this tells you, can this team raise $7.25 million by July of 2022? Some of them can't, because maybe it's their first deal or it's the biggest raise they've ever done or whatever. And if the thing doesn't close, they're going to send you your money back. And you spend all this time vetting it out and wiring and getting excited about it, and then they can't close it. So you just need to make sure that this raise size is equal to the capacity of the team to do. And that's why they bring in these extra guys to make sure that they can raise all that capital. And they'll give lots of perks to these guys with managing duties and things like that. So the next thing is the bonus depreciation. This is the total depreciation that everybody will split. Everybody in the deal will split that. I think it's more useful if you see a percentage. So let's say you put in $100,000 and you're going to get 40 or 60% depreciation. You could say, okay, well, if I put in $100,000 and I get 60% depreciation, then $60,000 of my investment is basically going to be kind of a tax write-off in year one. So your CPA can help you figure that out. That can also be deceiving, because if you are not a real estate professional, you really can't use as much of it. And the reason why is because your passive losses, which is depreciation, it's like things going down in value, but you didn't actually have an expense. It's just the way the building depreciates. You can only take that against your passive income. Passive losses go against passive income. And if you have active income because you own a business or you have a W-2 job, you usually can't take very much depreciation because your passive income is maybe a lot smaller than your active income. So that's why you need to talk to your CPA and make sure that the amount that they're saying you can depreciate applies to you. You have a maximum you can take if you have a full-time job, even on your passive losses. And so sometimes you can carry those forward year after year. But if you're getting a lot of losses every single year because you're doing a new deal every year, sometimes you just can't use it. So just make sure you meet with your professional and see how that affects you personally. Everybody's in a different tax situation. This next is the investor preferred return. This is going to be pretty much on everything you're going to see. It basically is saying that the investor gets the first 7% of all profits. So we have something that's called a capital stack, and that is going to be the order in which people get paid. So your mortgage gets paid first, then your expenses like your property manager, your property maintenance, things like that. Who gets paid next after the mortgage and the expenses are the preferred equity partners. Now, that's not really going to come into play in smaller deals, but when you're starting to get a really large institutional style deals, a lot of times they bring in preferred equity, and preferred equity is basically a limited partner who is bringing in a lot of money, and they've negotiated that they're going to get paid before the limited partners. So sometimes they'll give them a different class of shares. You'll have like the preferred equity will be Class A shares. Your common equity, like your limited partner, your $50,000 would be Class B shares. And then you might have Class C shares, which are the general managing partners. If you are not understanding if there's preferred equity in there, you're not going to be getting that preferred return. You're going to be lower down on the stack. And so you're going to get some sort of residual split, like an 80-20 or something like that. Or they might get their preferred return first. Then all their capital has to be returned. And then you get a preferred return, often the same amount, 7%, but it's a 7% preferred return after they've been completely cashed out. So it may be a long time that you're waiting to get your first distribution if they have to cash the preferred equity out first. So that is just something to watch for. If there's no preferred equity, which this deal does not have that, it just has regular common equity, you get the first 7% of the deal as a limited partner. Now, if you're looking at being a syndicator, a general partner, you literally get paid last. You're at the bottom of the stack. All the mortgage, the expenses, the preferred equity, the common, the limited partners are going to get paid. And then after everybody gets their preferred return, then you're going to split the rest of the profits, usually 70-30, 80-20. The general partners are going to get 20 to 30% of the profits, and they're going to be last. Everybody else gets paid first. So if the deal's doing really well, the general partners will get paid well, but usually they're working for not a whole lot of money. They might not get paid for the first 2-3 years. And so you want to make sure that your preferred return is healthy and that you want to invest in the deal, but you also want to figure out how those general partners are getting paid. Because if they are giving everything to the partners in the deal because they just need the deal for experience, because it's the biggest deal they've ever done and they just want it on their resume, oftentimes they'll lose interest in it because maybe a better deal will come along where they're making more money. And so you just need to make sure that they're motivated and they're getting paid. Understanding what we call that a waterfall. What goes to this person, 7% preferred return, return of capital, then a preferred return to the limited partners, and then down onto the general partners. If they're making less than about an 80-20 split, like if it's an 85-15 or especially 90-10, you need to make sure that they're getting paid and how they're getting paid and that they're not going to lose interest when they find a better deal. Sometimes they're just deal hounds. They love to look for deals, but then they always, as soon as they get one under contract, they're looking for the next one. You need to make sure somebody in there is a dedicated asset manager who loves doing it, who's good at doing it, and his attention is going to be on this deal while the other partners may go out and look for the next deal. So that's important because if they get enough deals in their portfolio, you want to make sure that the way that they're getting paid is enough to motivate them to keep their eye on the one that you've invested in. The $3.5 million renovation budget, that doesn't really mean much until you start comparing like the number of units and how much they're going to spend per unit. I typically want to see on a lower end property at least $7,000 on an interior renovation, more like 8. That's turning into 10 with appreciation. And then you want a contingency budget of at least 10%. So you multiply that interior renovation budget by the number of units. And then you're going to tack on a 10% contingency. And then you want to see that there is a healthy budget for the exterior stuff. So does the roof need to be replaced? Does the foundation need to be replaced? Those are the expensive ones. And you need to look at that budget and make sure that they've allotted for that. So the total budget doesn't mean a whole lot to me. I just want to make sure that it is applicable to the project, that it's enough. Because if they run out of money because they underestimated how much this was going to cost, then that's when you start getting into a capital call. And a capital call is basically when they tell all the partners, like, hey, we need some money and you have 5 days to send it or we're going to dilute you. And that'll be in the legal documents. We'll go over that during week 3, how to evaluate that. But the way to avoid a capital call is making sure they have a big, healthy renovation budget and a big, healthy working capital budget. All right, so this is a 3-year hold. I prefer when they put ranges like 2 to 5, because if they tell you it's going to be 3 years, they have to sell it in year 3. I never want somebody to be backed into a corner when they're selling a deal. I don't want them to be backed into a corner when they're refinancing a deal. I want them to give themselves plenty of time. I also don't want them to tell you it's going to be 3 years, and if they decide to extend it to 5 years, you're like, oh, I was expecting my money back at 3 years, and now you're telling me it's 5. It can lead to a lot of disappointment. So this should always be, even if they give you an exact number like this, in your mind, it should be a range, and which is fine. Because like I said, if they have to sell in a bad market condition because their loan only goes to 3 years and they have no extensions, like you need to know that. And the other thing that the hold time does is it gives you a sense of what this equity multiple means. So the equity multiple of 1.8 to 1.9 is, the first number is basically your original capital. So if it has a 1x, you put $100,000 in, you get $100,000 out, you made 0 return. If it's a 1.8, you put $100,000 in, you get $180,000 back. So this could be up to $190,000. Now, what I'm seeing right now on other opportunity comparisons, and you're going to want to look at a lot of these because you need to know what's normal and if what you're looking at is any good. It has to be in the same asset class. This is multifamily value add 1980s vintage. If you're comparing that to a mobile home park typically will have higher returns. So sometimes people will look at a mobile home park and be like, wow, they're doing a 2.5x in 3 years. And that's great. Maybe it's not that great for a mobile home park. So you have to compare opportunities within similar asset types, similar cities, all of that. But I would say in general, for a value add multifamily, class C, class B type of property like this is, a 1.8 to 1.9x is pretty high. Usually it takes at least 5 years to get somewhere in the 1.8 to 2x, but they're going to do that in 3 years. I looked at one recently that had a 20-month hold because it was just a land entitlement and they were just going to get their permits and everything to build, and then they're going to sell it. So after 20 months, it was a 1.35 equity multiple, which looks kind of low, right? But it's a year and a half. Well, that's actually pretty good for a year and a half. So the hold time really does affect your total return. If it takes you 10 years to get a 1.9x, that's not a very good deal. If it takes you 2 years to get a 1.9, that's a great deal. So a lot of these things, you cannot look at them in a vacuum. You have to understand how they relate to one another. And that hold time relates to a lot of things. This cash on cash during the hold period, cash on cash return is how much cash you have to put in for how much return you're getting out. And it's usually on an annual basis. 6 to 7%, I would say compared to other opportunities of this style, I would say 6 to maybe 9 at the high end is pretty normal. I would say somewhere in the 7 to 8% range is pretty normal. The other thing to pay attention to with cash on cash return is that this is not going to be even year over year. You might have a 4% cash on cash return the first year. That's how much cash you're making on your actual $100,000 or $50,000 that you put in. But the first year is going to be lower because they're doing a lot of renovations. They're going to have a higher vacancy because it takes longer to turn that apartment over and get a new renter into it. Vacancy is going to go down. And they're spending a lot of not only their working capital and their renovation budget, but they may be pouring in cash flow into the renovations as well. It's kind of a no-no. You want that renovation budget up front. But a lot of times there's just no profit because everything is being poured back into the property and the vacancy is high. So you might have 4% cash on cash in year one. And by the time you sell it, you might have 9, 10, 12% cash on cash return. So don't expect 6 to 7% evenly every year. And they'll usually have a sample investment timeline. They'll have that farther down. You look at that and that'll tell you how much money you're making based on what you put in, how much you're going to make, and when are you going to make it. So that sample investor worksheet is usually really, really helpful to light up what you're going to make each year versus just overall. This is basically how everything averages out after it sells. This internal rate of return is kind of like an ROI or return on investment, how much cash you put in versus the cash that's coming out. So it's basically like your profits after your expenses, taxes, all of that, and then how much you have left over. And it usually gives you a rate of return or like a return on investment, ROI. But the nice thing about this one is it takes the time value of money into account. So it does relate to the 3-year hold because basically what you have is a 17 to 18% total return. This is total return, but this is an internal rate of return. It tells you how much you're going to make and it factors in your opportunity cost. So if it takes you 10 years to make that, again, that's going to be lower. So you might still be getting a good 1.8, 1.9, but if it takes you 10 years, this is going to be 14%. So the shorter the turnaround time, the higher this number typically is. I would say on a 3 to 5 year hold, 16 to 18 is pretty typical on an asset like this. I'm seeing that getting lower and lower as prices go higher and higher. So when I start seeing 17 to 18%, I start paying attention. And the $21 million purchase price, it's just a factor of, can this team actually raise this much money, get a loan for that? Does the guy who's signing on the loan, does he qualify for that? Just an important thing to know. This slide takes a lot of time because it has a lot of financial metrics on it. The rest of this we can kind of blow through. So the reason why is because it's just a lot easier to understand, especially if you already know the market. We lived in Austin for 20 years. I know San Antonio pretty well. I worked there a lot. I was a real estate photographer. I get this. So basically these next couple of slides, I joke that they're just going to tell you how great this town is. Every pitch deck is going to have a section on how wonderful the town is. They're going to show you how close it is to the stadium, how close it is to shopping. They're all going to make it look really, really good. You have to take it with a grain of salt. You do have to do outside research on this, especially if it's a town you've never heard of. The other easy mistake to make is the submarket is no good. So because I know San Antonio, I know that the northwest side has the highest end properties. And I know that the northeast the northeast has the best, the northwest is next best, but the southwest is usually the worst. South, very low income, poverty, a lot of crime. So you can go look up this address on a website like Trulia and zoom in on the crime maps. You can go into Google Maps and drive around with the street view. You can go visit it in person and drive around. And when you drive around, you're going to want to go shop the comps like the other apartment buildings in the area. You want to see what they look like, what they're charging, the condition relative to yours. You're also going to want to look up major employers and make sure that those commutes are less than 30 minutes. I would say that's the top end before you're going to start having issues with it. I see I-35 here and the 410. I understand the I-35 and I-30 cut through San Antonio. They have a lot of interstates, and they've got the 410, which is a loop around the outside. Anything inside the 410 tends to be higher priced than anything outside that 410 loop. So this is just understanding the market. If you've never invested in that market before, I do spend some time researching that, talking to other investors, checking out crime, checking out commutes, checking out where the major interstates are and the shopping. But because I know San Antonio, I can skip most of this. And also, like I said, they're going to make it look as good as it possibly can. So you're going to have to do some outside research, just getting familiar with the town and city data, Wikipedia, talking to people from there. Is this a good area or not? All of that's how you're going to research these claims. We all know San Antonio is the next Dallas. You just have to make sure it's in a part of San Antonio that is pretty good. So they're going to tell you great industry, great everything, how close it is to the airport, how close it is to downtown. That's not bad. It's not out in the middle of nowhere. Really what I want to see is the overview of the map showing me what neighborhood it's in. I would put this on Google Maps and I would kind of flip it around and then figure out how close to the good part of town it is. Usually workforce housing is not going to be in the nicest area of town, which is fine because Class A turnkey properties that don't have any value add typically don't have as high returns. There's a compromise between the best area of town and a turnkey beautiful property that has no value add, that the return's going to be lower. Those are pension fund kinds of deals where they're only going to get 8% total returns, and that's not what we're after typically, unless you're in preservation of capital mode. You're retired on your passive income and now you just don't want to lose money, you just want to grow it in much less risky projects. But if you're investing for high yields, you definitely want to find some kind of value add and make sure it's in a neighborhood where it's growing, it's not totally crime ridden and trashy, but also not like the nicest part of town. Just glossed over the area. Now we're going to talk about the property itself. And this is where it can get really nitty gritty on the returns, and you really can dive into the numbers and get lost in the numbers here. I think it's important to remember, if you spend a lot of time evaluating a deal and you end up rejecting it based on some detail, which happens a lot because maybe there's something in the legal language, maybe you find out there's some sort of criminal background on one of the operators, or that the property has a huge problem with foundations that they didn't account for in their renovation budget. You spend a lot of time vetting these out, but I know hedge funds who put millions of dollars into these deals and they spend, I don't know, 2 days maybe with a team of people who know what they're looking at. It's more of a spot check. They really leave it to the operators to trust that they know what they're doing. So they're just going to spot check a few things, make sure that their comps are in line, make sure that their budgets are in line. They're not going to pick this apart with a fine-tooth comb. And I think a lot of beginners really get stuck in that mode of feeling like they can't invest in something until they know how to pick it apart with a fine-tooth comb. I don't even know how to do that. I just make sure that my investments are the size that I can handle, that I can sleep at night. If I lost that entire $50,000 investment, how would I feel? If I do my best to put my money in a deal and diversify around, you know, only $50,000 per deal, or when I make more money, it's $100,000 per deal, they're not all going to go bad, right? And I'm going to learn something each time. So sometimes 50 to 80% comfortable, go ahead and throw some money in, because likelihood is it'll work out. You might lose money on one or two here and there, but overall, you're going to be ahead in your portfolio. You cannot pick these properties like people try to pick stocks. It's just as pointless. You're investing in an area, you're investing in a team, you're investing in a certain type of asset. And if you do this enough, eventually you will find one that doesn't perform and the one that doesn't do well because of a multitude of bad circumstances that happened. And if you let that fear rule you, you'll never, ever put money in a deal, or you'll never make an offer that is likely to get accepted. If you're going to be a syndicator, you'll think of all the things that could possibly go wrong and you'll be terrified. If you're making super lowball offers and you're just not getting any of accepted, you might want to go for a smaller deal that you feel more comfortable offering a little bit more for to make a competitive offer. If you're looking at deal after deal after deal and you're just too scared to pull the trigger, maybe a website like Fundrise or CrowdStreet would be a better fit, because you can pay $500, $10,000. and you can kind of learn your ropes by making sure that your investment is sized appropriately to your risk tolerance. Some people feel very comfortable just throwing money at stuff. Some people have to know every detail of a deal. You will never know. Every pro forma you're going to see is not going to be accurate. Every single one of them. Stuff happens, stuff changes. They'll do better, they'll do worse. At the very least, once you feel, like I said, 50 to 80% comfortable with something, go ahead and throw the appropriate amount of money at it, and then just keep an eye on it and diversify. Don't hyper diversify. That's super time consuming because you have to vet deal after deal after deal. But spend a certain amount of time vetting a deal. If you don't feel comfortable after that set time that you've set, don't invest. And if you're finding that you're not comfortable again and again and again and again, you might have to lower your standards a little bit. Okay, this is just giving you some basic property information. I don't think that this stuff is quite relevant to the first pass. This would come more into play as you are looking at the comparable properties that they are rating their rents against. So this can come in handy when you get deeper into your due diligence. But on a first pass, I usually just see the unit mix here. If it's in the suburbs, I want lots of 2 bedrooms. If it's downtown, studios and 1 bedrooms are fine. If it's way out in the middle of nowhere, they really need to be bigger, 3 bedrooms, because families are going to move in there and they're going to stay for a really long time. But a bunch of studios way out in the middle of nowhere, not a good fit. And you will run into that. So that's what the unit count for me on the first pass, at least, is just to make sure it fits the area and fits the market. This can be important because you're going to want to see what kind of wiring and what kind of plumbing. So they have copper wire. If they have cast iron, it's an old building. If they have cast iron plumbing, a lot of that's going to need to be replaced. And you're going to want to see a healthy plumbing and wiring budget. If it's aluminum wiring, that's extremely expensive to fix. And so I do like that they shared this. You just have to make sure that if you're seeing something on here that is disturbing, like if this said aluminum wire, or if it had plumbing on here and it said cast iron, I would just want to make sure they had enough time built into their renovation and enough money set aside for it, because if they know about it in advance, then they need to be prepared. Now, if they have copper freshwater pipes, you need to know the lifespans of these major systems. And you're going to see differences wherever you are. For example, in some parts of the country, they're going to have something called a chiller, which is very, very expensive to replace. And so having a basic idea of how these things are heated, cooled, where the water comes from, where the electricity comes from, and the age of the roof and the condition of the foundation are really the important parts. Something else that can be really expensive is resurfacing a parking lot. Exterior paint jobs, they're expensive, but they're not that big of a deal. It's these major systems. You just want to make sure that either they're in good shape, that they've been vetted out by some sort of an inspector, and they have some sort of an inspection report that can prove that to you, or if it's not in good shape, that they have enough budget in that renovation budget to take care of it. And that's why that total renovation isn't as important to me. I like to see a little bit of a breakdown to make sure that they have planned ahead. On older buildings, I like to see a big plumbing line item, because those pipes will break and burst. Cast iron will rust, it will leak, and freshwater copper lines will pinhole and spray and flood. And so there are usually a lot of plumbing repairs on a building in the 80s or older. So just make sure that that's either been redone, or you have a big budget to take care of leaks and flooded apartments when it happens, because on old buildings, it will happen. Again, these photos are super helpful, but oftentimes what they're showing you are renovated apartments, or the model apartment. And this is unclear whether or not this is the model and renovated. What does it look like before? So these are probably the current pictures. I haven't seen in here how many of these apartments are renovated already and how many they're going to go and renovate. A lot of times the previous owners will say they renovated it, but then when you go and see it, it doesn't look that great. And there's a lot of rooms still in there. And so they'll say we're going to renovate 50% of the units because 50% were already renovated, but they may have to go back and upgrade those other 50%. Some people's definition of renovated does not match what the market can tolerate. There's more room in there to make it nicer and get even more rents, and that takes time. Make sure that they understand the condition of the renovated units if you're buying something that's already been partially done. And that's very, very common in these older buildings to have some of them done. Scope of work. This is basically telling you what they're going to do. They're going to put in granite countertops. If you see like stainless appliances, granite countertops, new cabinets, instead of just refacing, you just need to make sure that budget can support it. This is probably a $7,000 to $10,000 remodel, but if they're putting in stainless appliances and they were putting in new cabinets, then I would want to see a higher budget per unit. They're spending $500,000 on the exterior. That seems like a pretty healthy budget for a complex of this size. I'd like to see a breakdown, how much of that's plumbing, foundation, all that kind of stuff. This is important because it tells you the scope of work, how big and ambitious this business plan is. Because if it's a major renovation, then you're going to have a lot of downtime, a lot of vacancy, and you need to make sure somebody on that team has a lot of experience managing a construction project of this scope. Too many people say, oh, we have a super experienced contractor and a super experienced property manager, but those asset managers who work on this team may have never done it. Now, I know with Fair Winds, they have done some big renovations because we invested in a deal with them in Houston a couple of months ago, and we already vetted them out. So I know they do have extensive construction experience, but depending on the scope of work, you're going to want to make sure that the team's experience is up for it. This is not their first time doing this much work. This isn't a ton of work. This is what I would call a medium value add because they don't have anything huge here like new roofs or new parking lot, new plumbing, new wiring, foundation repairs. Those are the major ones. This is stuff that they have renovated in the past that is not this building. This is showing you their experience level. When the first time I went through the slide, I was like, wait, what? These units look like what? That was concerning, but he said, no, this is another building. It's just showing you how we have experience doing this kind of construction. I thought, oh, okay, that makes more sense. So these are before and afters, just showing that they're competent to execute the business plan. Again, the tax benefits, this is really helpful to share with your CPA, but we're not going to go through it because everybody's situation is different. It depends on if you're a full-time real estate professional or if most of your income is derived from passive income, then you'll be able to take higher depreciation. If you're a W-2 worker and your spouse is not a full-time real estate professional, you're not going to be able to take as much. So just make sure you talk to your CPA about it. These are some more financial, basically ratios. The cap rate is the net operating income. Operating income is property-related expenses. An example of a non-operating expense or revenue would be some legal fees. Maybe the neighbor wanted to have a lawsuit. That's not an operating expense. So we're just talking about what you actually make on the property and what you spend on the property. You may have some extension fees on your loan. That would be a non-operating expense. What they're trying to do with the operating income or the net operating income or the NOI is compare if somebody else was going to run this building, they're going to run it fairly similar to the way you run it. But you're going to have a different loan. You're going to have a different legal situation. You're going to have all sorts of differences for non-operating expenses, but the operating expenses should be pretty consistent. So you take your net operating income and you divide it by either the price you paid or the current market value, and that will give you a cap rate, or it's called a capitalization rate. It means how much money, price, did you have to spend to earn that net operating income. I would say a 4.75 going in is pretty typical for a larger city like San Antonio in this current market. The lower the cap rate, the more expensive the property. The higher the cap rate, the cheaper the property, and typically the higher the risk because they're giving you a deal because it's in really bad shape, or it's really old, or it's really in the middle of nowhere. You're going to want to see if the cap rate's higher than about 6 or 7%. You want to find out why. Are they in the middle of nowhere? Or are they just getting a super good deal? And if they're getting a good deal, why? Why does that owner want to sell so bad that they're willing to sell it for like a 7 cap? So 4.75 is pretty normal. The exit cap, you want to see that it's higher than the going in cap. This is what they're planning to sell it to the new buyer for in a couple of years. If they're planning on selling it for the same cap rate that they bought it at, big red flag, because if we're going to a recession right now and these prices are going to go down, the cap rates are going to go up. So you may have bought it at a 4.75, but you're not going to be able to sell it at a 4.75. And you have to pretend you're going into a recession when you're underwriting these. Because sometimes you might be, and you never know when that's going to happen. Everybody thought it was going to happen 2-3 years ago, probably happening now. And I like to see a good, healthy spread between what they're planning to sell it for and what they're planning to buy it for, because that shows that they have some conservative underwriting. And these assumptions, these financial assumptions, they're telling you can get these returns, are based on selling it in a worse market than they bought it in. And that's really important for conservative underwriting. There are some other red flags to look out for to be conservative. Like I said, the plumbing, age, things like that. You just want to make sure they're basing this in reality. And this is a big one. The pro forma cap rate is basically what they're going to operate it for internally. Their net operating income versus what they're going to sell it for is the new buyer's cap rate. But what you paid for it is based off of this cap rate. And then you're going to raise the income enough that once you get it stabilized, you're going to be making an 8% return on that capital that you put in. So you're going to want to see a spread here between going in and the pro forma. This is internal. This is what a new buyer is going to pay for it. If you're buying it for a 5 and you're operating it at a 7, usually that's a pretty good split. This is bigger than that, so that's pretty good. And their exit cap is higher, so that's comforting. 80% is their loan amount. The loan to cost is different than the loan to value. The cost would include renovations, whereas loan to value only is the purchase price. So an 80% loan to cost is pretty high, which is great because the bigger loan you can get, the better returns you get, but it does increase the risk. Something that's an 80% LTC, I'm going to grill them about their loan terms. I'm going to make sure that if they have extensions built in, because it's a 3-year hold, if they have 2 one-year extensions, what are the conditions that they can get those extensions? Usually they have to be making a certain amount of money above what the mortgage is before they can qualify for that extension. And if it's going to be tight, then they might not qualify for their extension. And then that's when they get caught selling in a bad market. I'm going to make sure they have extensions, that they have a reasonable expectation to meet the requirements for those extensions. And I'm also going to find out what their options is if they run out of extensions. Can they sell it? Can they refinance it? What's that going to look like? If they have to refinance it, usually the returns will be higher because you'll get your money back sooner. You get your part of your money back at, like, say, year 2, and then they'll hold it for, say, 5 years. But it's riskier because, especially in a market like we have now with interest rates going up, you just don't know what to expect. So they're guessing at those numbers that they're going to refinance it at based on today's conditions, and they'll probably bump it up a little bit just to be safe, right? But who saw interest rates almost doubling over the last couple of months? Like, nobody saw that coming. We knew they were going to go up, but there are also people talking about how they're going to go negative. If you're basing your profits off of a refinance, that's risky. So this one does not have a refinance factored in. If they end up refinancing it, you might get some of your money back sooner. But because they don't have a refinance planned in, you need to plan on holding your money in there 3 to 5 years. These are not liquid investments. There's no way to get your money out unless you sell your shares to somebody else, and that's a pain. It's not as easy as selling a stock. Now, there is some talk about creating a blockchain and tokenizing these assets so you can buy tokens and then you can resell the tokens like cryptocurrency. And that should be coming online probably later this year, maybe next year, are the earliest estimates for some of the companies I'm looking at. So these may become liquid, but this particular one is not. And none of them are yet. But watch for that in the next couple of years. You cannot get your money out. You know, when you put it in, it doesn't matter if your kid has cancer and you need to pay for that treatment. Like, it's very, very difficult to get your money out of these. It's possible, but don't count on it. The last thing on here is just really understand what the loan terms are. Is there a prepayment penalty? If they end up prepaying, how hard is that going to hurt, right? If they end up selling it at year 2 or something. If they have to refinance, just figure out how they're going to get those extensions. Learn about financing, because that's the #1 reason that a property will default and you'll lose all your money because they basically have to hand it back to the bank, is loan terms that force them into a corner to refinance or sell in an environment that is not favorable. So you want lots of wiggle room in there. Rent growth at 4%, I like to see the rent growth either the same or lower than the expense growth. So in this case, because it's higher than 3% and it's higher than the expense growth, because basically you're saying that your rent is going to inflate at a higher rate than your expenses, I just want to see the data. Where did you get this number from? Write down your questions as you're going through this and either call them up on the phone or send them an email. If you don't feel comfortable having it in a phone conversation because you don't know enough about it and you don't want to sound stupid or scrambling around for what you want to say, just write it down, send them the answers. They're going to have positive responses to all of these. And so you might want to show it to somebody else who is going to try and talk you out of investing in it. I think the best person you can have on your team is somebody who tells you why they wouldn't invest in a deal. And then you can kind of decide for yourself based on the positives you're getting from here, the positives you're getting for the operators, and the negatives that you're getting from other people. I wouldn't ask like your brother-in-law who doesn't know anything about real estate, right? I would ask somebody who knows something about real estate to try and kill this deal for you. And if you're comfortable with the downsides, then you can move forward with it. But you do want to find the downsides. Every deal has downsides. Sometimes you just have to look for them a little harder. You may have some homework. If I have said something that you don't understand and then you don't know the terms for, write the stuff down and go look it up. Feel free to reach out to me, ask me questions. It's just like learning a language. When you go out to the shopping center and you're trying to buy something in a foreign language, you're going to hear words that you don't know, but you're going to have a little notebook and you're going to carry it around or on your phone and you're going to write that stuff down. And you're going to get home and you're going to look it up in your dictionary, and next time you come across that word, you'll know. So this isn't something that I expect you to be able to get from one time over. You might have to watch this video a couple of times. You might have to do some research. We do have some resources, a glossary, and some other things to help you understand some of these terms. If you don't understand, just write it down and go do some homework. People who are good at investing in this type of stuff are people who are willing to do their homework. And I'd say plan on spending 4 to maybe up to 10 hours researching this stuff and learning about it before doing your first deal. If you're spending an hour on this video, then you got 1 hour out of the way. So congratulations. This whole series is going to be about 4 hours, and I guarantee it's not going to be enough. So I would plan on spending another 4 or 5 hours on top of this 4-week series doing your homework. Come to the club meetings Monday nights, because that will also help you to kind of figure out some networking, some education. I just see one question. They asked, what does the IO mean on the loan? That means interest only, which is great because you have more cash flow. I want to see what this loan is converting to at the end of 3 years, because it's a 3-year hold. They have a 3-year interest only. I need to know what the loan options are after that if they don't sell it. Can they refinance it? Are there extensions? I don't know. So that's really important to find out. Sources and uses basically just tell you what their sources of money are. So they're getting debt, no preferred equity. That's what we were talking about before. So that's good right there. The limited partner equity. And then here's what the sponsors are putting in. That's their skin in the game, $313,000. So between the debt, all the equity, it's $27 million is the source of capital coming in. I think the property price was like, what, 24, 25? So this is going to be above that, which is great because they need construction money, they need working capital, they have closing costs. And you're going to want to make sure that it just matches. This number should be the same as the uses. If you go into a sources and uses and these two things don't match, that is a big problem, because this is just basic that sources and uses should match. And if it doesn't match, it's a major error. And then I would look suspect at the entire deal if they can't get the sources and uses table correct. So the purchase price, $21 million, says it right there. And closing costs, their acquisition fee, that's the money that they get paid for just basically putting this deal together. They're going to take a little bit of a fee up front because they may have spent months to a year working on this, and they're going to take a little fee. I wouldn't want to see it higher than about 3%. 2% is pretty normal. 1.5 is not bad. The bigger the deal, the lower the percentage should be, because if they're buying a $70 million deal and they're taking a 3% AC fee, like, that's just greedy. They're motivated by fees. They're not motivated to get this property to perform. So this fee here and that amount, that is just fine. It shows me that they are motivated, they're getting paid, but they are not getting paid so much that they lose interest in the deal on the front end. You want to see that they're motivated by returns, not by fees. Their Capex, that is your capital expenditures. That is basically your renovation budget. It's all the deferred maintenance that the previous owner didn't take care of. Water heaters, carpets, just stuff that they should have been fixing all along in their repair and maintenance budget, but they didn't. So now it hasn't been done, and you need to do it as a capital expenditure. This is not an operating expense. This would be outside of it. An operating expense is a Capex reserve. It's amount of money that you set aside so that when the roof goes bad or you need new plumbing, you already have that cash to fix it. So you do want to see a Capex reserve line item budget to make sure that when things go bad that they didn't plan on, or big things that wear out, parking lots and things like that, that they can pay for it. The reserves is an operating expense. The Capex is not. So they're just basically having to play catch up to get the property up to stabilized condition. And that's why it's not an operating expense. It should have been done all along, but it wasn't. So you can see this matches. The percentages match. The total amount of money matches. I wish I could say I've never seen a sources and uses that didn't match, but I see it all the time. And that's just a red flag. I don't think I would invest in a deal if this basic thing wasn't taken care of, because what else? It's either a big error or they don't know what they're doing. So if I ask them why it doesn't match, oh, sorry, that was an error, and they fix it and send you a new copy. That's a little different. Okay, here they're going to tell you about how great the market is. The market is even wider. This is Texas. Here's how great San Antonio is. Now here's the map that I was talking about before. They've got this inner loop here, the 410, and then this outer loop is the 1604. I would say stuff between the 410 and the 1604, especially in like Shivano Park up in this area right here, Castle Hills. Helotes is a little bit far out, but this area right here is probably the nicest area of San Antonio. Selma, Live Oak, Shirts, Converse, all of this across here is really nice. Everything like right off 1604, Stone Oak, Hollywood Park, those are pretty nice. Alamo Heights is starting to get a little downtowny, starting to get a little seedy. Out west here, not so bad. Out east, it's starting to get pretty bad. When you get down to this area down here, not so great. This is not as bad, but still not so great. So you just definitely want to see stuff in San Antonio on this north side and as far to the west as you can. Inside the 1604, if it's outside, it's usually just too suburban, new development, stuff like that. If it's inside the 410, sometimes it's a little downtowny, it's a little old. I like to see things kind of in this circle right here when I'm looking at San Antonio for workforce housing. That's another thing you have to go research in Google Maps. Okay, we got a question. What options could negotiate on a side letter for such a deal if you come in at 5x the minimum investment? Usually better preferred return. If you're bringing in $500,000 or you're bringing in $1 million, you can usually negotiate a chunk of the general partnership for yourself. If you have the kind of money that you want to put in one deal, that much money, I would say that don't stretch yourself to do that, but it's definitely an option of how to buy your way into a partnership and get that on your resume. And I tell people 300 to 500 is usually where you should come in at if you want to negotiate for some GP and for an improved preferred return. You can also ask for paying less fees. Maybe you don't want to pay an acquisition fee. Maybe you don't want to pay a management fee, like an asset management fee. There are usually 4 fees: acquisition, asset management, refinance, and disposition. I really don't want to see them charging all 4 fees unless they're really low. 3 tops, usually it's only 2, and acquisition and asset management are the most likely. Sometimes they'll put a disposition. By the time they're putting a refinance fee on there, come on, lots of fees here. So if they're super, super low percentages, that's fine. But you could ask to have those fees reduced if you want to bring in a big chunk of cash. And that's what our club does. We'll bring in $500 or $1 million into a deal. And as a group of 10, maybe 15 investors, we'll pool. And then we take that chunk and we go in and we ask for better pref. We ask for a piece of the GP to protect that investment. Sometimes we'll ask for a share of the acquisition fee. It's our money. We just basically take it back. Or we'll ask for a share of asset management if we're doing a significant amount of asset management or monitoring it. We might get a little bit of that fee. So those are the kinds of things you should ask for. Just a general partnership shares will give you a little slice of those GP distributions on top of your limited partner distributions. It really depends on how much you're bringing in and how much the sponsorship team needs you. If you brought in $1 million to a huge institutional type of buyer, they'd be like, we don't need your money, right? But if you bring in $1 million to a smaller operator, they're like, what do you want? So it really depends on the operator, how much they're going to give you, but it's always worth asking if you want to put that much money into a deal. Last thing, they're giving you some more San Antonio stuff. I'm not sure why they split it up into 2 different sections. Usually I put all the city and market stuff together. So market and neighborhood and area, it's very, very similar. It's going to have a lot of crossover here. Population, 1.6 million. I like to see at least 100,000 to 200,000. Like say Little Rock, Arkansas, capital city, has about 200,000 people. I bought some properties there. Capital cities I like because they have a lot of government jobs and military jobs and universities and things like that. So capital city at 200,000, that's fine. Obviously, San Antonio is not the capital, but it's super close to Austin. It's like an hour and a half. It's almost the same city. They're kind of growing together. Job growth, you kind of have to look this up and compare it because 1.6%, that's a pretty good growth rate, but you're kind of looking at it in a vacuum. Well, how does it compare to cities around it or other states or to the US average? So sometimes putting in how it compares to the averages is really helpful, but now I have to look that up because it's not here. Population growth is 1.9% 1 year, pretty good. If I say a 5% on a town this size is pretty high. If it's a small town, less than 100,000 people, I need a 10% growth rate, which is pretty hard to find. Rent growth has been 13%, which is why their rent growth is projected at 4%. That's fairly conservative based on what's been going on. But again, we're going into recession, so I like to see a nice conservative number like 3 or 4%. Median household income, you want it to be high, but you also have to see that how it compares to, can they just buy a house? San Antonio is the kind of market where typically they've just been able to buy a house. They're not going to rent for years and years because the houses are cheap enough and their income is high enough that they can just buy a house. So you want to make sure that the median household income is strong. It's about 3 times the rent, like their monthly income would be 3 times the monthly rent. But you want to see those houses trending upwards and getting more expensive, pricing people out, which would make more renters. Another thing here you want to check that they don't have is the percent of renters as versus the entire population. So renters to homeowners is really nice to see. If it has a high proportion of renters, they usually tend to stay longer and you'll have lower turnover. Then we're just going to get into some of these comps. They're going to give you like a normal occupancy for the market. This is useful, but I find the actual comps, like the nearby complexes, to be a little bit of a better storyteller. New units added and absorption. This is great because it tells you how much inventory there is. The price per square foot is spiking, and the new units added, you see a big shortage here because their absorption is really high, but not on the new units. Then they kind of caught up. Lots of new units with a lower absorption. I don't usually like to see that, but that's unusual. Usually I like to be more even like this, absorption a little bit higher, or at least close. But look how many units have been brought on. That's a lot. Usually this would be not a great sign, but then they're showing that price per square foot is still skyrocketing. But I would want to do some research on why this absorption was so much lower than new units brought on and why it's skyrocketing, even though absorption is still lower than new units. Because that's, to me, is a discrepancy that I would want to look into. Here are the rental comps. Again, this is something you do in Google Streets. You drive around, you look at these addresses, you see how they look, then go to apartments.com and you'll see some interior photos of these. You may see how much they're going for. Just want to verify these. The biggest thing you're looking for is an apartment that's nearby that would be a good comp that they left out of here because maybe it's not renting well, so they're cherry picking. That's what you're going to want to watch out for. And just some apartments.com and some Google Streets is plenty. Unless you're going to go visit the property in person, you'll want to go like secret shop the comps. But otherwise, I think apartments.com and Google Streets is good enough as long as the rent increase that they are suggesting is reasonable. This is showing you what it's going for. And it's pretty close to the average, right? So you want to look at the comps of what it's going to look like after you're done renovating it, not the current comps, because they may be in bad shape too. If you're going to make it nicer, you need comps that reflect how much nicer it's going to be. Because like I said, this is already kind of close to the average. So what kind of rent bumps do they have in there? I like to see $50 to $100 a month per unit. I'm starting to see that go up. It's not uncommon to see $150 or even $200, but if it starts to get above $150, I want to do a little bit more research and make sure that's reasonable. $50 to $100 is usually pretty easy to get. Higher than that, I need you to prove it to me. Economic overview. This is what I was talking about with the sample investment. So sample of $100,000 on 3 years. Your cash on cash return year one, like I said, it usually sucks. You're going to put 100 grand in. You're not going to make any money. There's just nothing there. The second year, you're going to start picking up. Remember, this is a 7% preferred return. And so you're never going to make your preferred return during the hold because it's always anticipated to be lower, which means that the general partners are not getting paid until they sell it. Now, if these are conservative, they may make their preferred return and they may get a little distribution, but it's not going to be enough that they're going to be rolling in it. They really need to get this thing turned and flipped. This is what I would call a flip. They're not making a ton of cash flow, which is why the cash on cash return is this year 1.55 equity multiple or 1.5x. And then these payments here, your cash flow last year, if they go to year 4, beginning of year 4 is when they're going to sell it, looks pretty good. And that's what's going to make up this 1.55 up to a 1.8 or 1.9 is when you add these profits here to these distributions here. So your total cash flow plus your total refi, you add that up, which is right in that amount. It's not so great the first year. It gets better. But again, you just need to make sure those general partners are keeping their eye on this, because if they're not getting paid because you're not getting your preferred return until they reach over 7%, they're not getting paid. So make sure that they have motivation to keep their eye on the ball. This might be a reason for them to be getting a higher asset management fee, because I want to make sure they get paid, that they're motivated. Again, this is just the same thing. Their total return is 192, which would be a 1.92x. So it's on the high side of that. And so if you add that up, that's about right. 78%, pretty good in today's market. Most of this is just a sale. It's a flip. If you're going to make all your money on the back end on the sale, it's a flip. Cash flowing deals, cash flow from day one, and they just throw off a lot of cash. Maybe they don't go up in value. Maybe it's not a flip. You're going to hold that for 5 years, 10 years. That's a different kind of investment. You'd have a higher cash on cash return, but you'd have a lower total return or lower internal rate of return. So if you're in preservation of capital and you're just trying to live off your distributions because maybe you're retired on your passive income, you're going to want that to be higher, and that can be lower because it's less risky. So your goals are really going to determine how these numbers look to you. Right now, I'm investing for cash flow because we're trying to retire. And then after we have our base level of cash flow set up, then we can go back to investing for a higher yield because our basic cash flow is already taken care of. Questions is how to reach out. Go to their website, email. Like I said, this is a 506C, so usually they'll have something here about how to get accredited, how to get proof of accreditation, and you're going to have that verified by a third party before they can accept your investment. Sometimes they'll have a link here where to go do that. Sometimes they'll have a link to their portal so you can sign up and make your soft commitment, like, hey, I'd like to put 100 grand in this deal. Then you sign all your legal documents and then you send your money over. So usually they'll have instructions like that on the back page, and this is all like hyperlinked to their website and stuff. Okay, we got some questions. Go ahead and unmute Kelly and then Siva.
So my question is, have you ever evaluated new construction, new development deals?
Yeah, so we did a high-rise project in downtown Salt Lake City, and I didn't know how to evaluate them when I started that project, so we brought a partner on who knew how to do it. He's got another deal right now, and then we're going to be looking at some new construction in the club on Monday. I would say typically the cash on cash is lower because there's no cash flow early on. During entitlement means getting all the permit is entitling. And then during construction, obviously, you're not getting any rental income. So the cash on cash return on those are typically lower, but the total return is going to be higher. And a lot of times the preferred return is higher, but it accrues till the end. So it's basically you make a ton of money when they're done with construction and they refinance from their construction loan into their permanent debt. That's when you get paid.
Yeah. Okay. And you said you're going to talk about that or go over that a little bit on Monday?
We are looking at a new construction deal on Monday, but it's not multifamily, but we did look at a multifamily new construction just recently, and they still are accepting cash in a joint venture for that one. It's definitely a different, that's what I'm saying. You need to compare, like, is this a mobile home park? Is this new development? Like, how does it compare to similar opportunities in similar markets? I would say if you have a huge difference between your total return, let's say it's high above 20%, and your cash on cash is low, like 5-6%, that usually means that those profits are derived from some sort of a refinance, which in this case of new development, definitely because you got to get out of your construction loan and refinance to your permanent debt. And usually that's what it's showing. If there's a huge delta between those things, it's usually dependent on either a sale or a refinance. You have to find out why that delta is so big, as if it's huge, then there's a story behind it.
Right.
You'll see on super turnkey low risk deals that they'll have a cash on cash maybe 6 or 7% and a total return of 14. That's just a cash flowing deal. It's just one of those solid turnkey low risk kind of things. So you will compare the numbers and the relationship between the numbers based on the asset that you're looking at.
Okay. All right. I just have one I was about to put in on, and yeah, I mean, obviously there's some differences, but this was super helpful. Thank you. Just to go over everything in a basic way, all the terms that we hear all the time, but putting them all together. Thank you.
Yeah. I think the biggest thing with new construction is it has a lot more line items in the budget. And that means a lot more can go wrong, because if you've miscalculated a cost on a value add, it can throw things off. But because new construction has so many more costs that can be a little bit off, they can really add up to make big differences. Right. So that's the thing, is there's just a lot more things to think about, a lot more line items, and they're much more custom to the deal. So they depend on like the type of soil you have, how deep you need to dig your foundations, like all of that is very, very project specific. And so those details, I think that's why people sometimes are intimidated by new construction. But experienced investors love new construction because it's such a high return. They don't need the cash. So once we have our basic cash flow and we're retired on our passive income, I probably will start investing in a lot more new construction because the returns typically are higher, but it is a little riskier because stuff can and does go wrong.
Yeah. I mean, honestly, I see it as the highest kind of risk in real estate.
And that's why it's really important to understand these numbers and understand good markets, strong markets, and have an experienced team doing it, because you can make a lot of money in development, but because you can make a lot of money, you're also willing to lose a lot of money.
Right. For sure. So, okay.
All right.
Well, thank you.
Yeah. Thanks, Kelly. Siva?
Yes. So how can I do the due diligence if the operators are honestly putting their money and they're not taking the investors' money for escrow or any acquisition fee or any sort of fees?
Are you asking how you do the due diligence on the fees that the operator is taking?
Yes. Yeah.
Okay. They need to disclose those. That will be in the legal documents. If they haven't disclosed it in the pitch deck here, if you decide you want to do another layer, that's when you're going to get, and this is what we're doing next week, that's when you're going to get the spreadsheet and start picking through it. And you're also going to get their legal disclosures or their PPM, because they will give you tons of details about exactly what the fee structure is. Because what they tell you in the deck is what they plan on taking, but in the legal documents, they say we can take up to this much, and it might be higher than what they're planning. So you have to find out, like, okay, when would you actually take that much? What would have to trigger you getting a higher fee, things like that. So the legal disclosures will have a lot of that information. It has to have it in there. If it doesn't, it's basically fraud, because they haven't disclosed everything that they need to. So you will read about that in the disclosures. And if it doesn't match what is in the pitch deck, then you can ask about it. It usually doesn't match, though. So it's not a red flag, but you just need to find out if it doesn't match, like what would make you take a different fee than what you've shown us that you're planning on taking on the spreadsheet and the pitch deck.
Got it. Thank you.
Yeah, good question. So next week we will be doing, like I said, the spreadsheet pro forma. And then the third week we're going to be doing the PPM, or the legal disclosures, to look for those kinds of things that might not agree with the pitch deck. It's not uncommon that they don't agree, because it's either an error or the difference is like what they're planning on doing and what they could legally do. Okay, Marcus?
Yeah, my question is about the deal metrics and the time horizon. Like you stated that if the time horizon changes, like on this deal, it will change the numbers.
Mm-hmm.
Do you ever go back and look at previous deals they've had, or would that impact you in the future? If, let's say, they had a 3-year and it was pushed to 5 or 6, would that be the kind of thing that you would be worried about in the future, or would you go back and look and see had that happened to them before?
I usually will ask them if I'm really serious. I don't want to bug them and ask them a zillion questions if I'm not really serious about investing. But the first time I'm working with them, I ask them more about themselves and their track record than I'm going to ask them nitpicky things about the deal, right? Because sometimes it's like marrying someone on the first date when you throw money at it for the first time. Spend more time looking them up. So I'm going to ask for their real estate owned. It's basically a resume, or an REO is what they call it, or an sREO, a statement of real estate owned. And they'll tell you all the properties that they've had, their percent ownership in it was 50% or 0.05%, makes a difference. And you're going to see which ones they've already sold. And see, these guys say they have 2 full cycle deals. I'm going to want to see the returns on those. Especially, they've been in business for 4 years. They've had 2 full cycle deals, which is great. But it was in a kind of a bull market, and everybody was making money and looking like geniuses during that time. So you just have to look at what they sold, what the returns they got. You definitely want to see what they own, how it performed as specifically as they're allowed to tell you. And then one extra thing that you can do that you want to make sure you're not getting scammed is to look up the title holder on those properties that they say they own, or that they say they did own. It's easier on the ones they currently own. And make sure that that matches the LLC that you're expecting. Usually it's not going to have their name on it, right? Because we're going to name it like 123 LLC, but you just make sure, like, is this your LLC? Talk to their lawyer, things like that. Because it's common for people to tell you they own things that they don't actually own if they're scam artists. Obviously, reputable people would never do that. But it is one way to weed out scam artists for the first time you're working with someone. And I would say referrals. If you've heard about them from somebody else who's actually done business with them, that's going to carry a lot of weight.
All right. Thank you.
Thank you. All right, Sri, we've got a question.
Hi, Emma. Thank you. Yeah, it's a great meeting tonight. Thanks for all the information. I wrote down lot of notes. Quick question on the spreadsheet pro forma you mentioned for next week.
Mm-hmm.
Is that same as like a detailed underwriting, where we use a template, to
Yes.
put in all the numbers and to calculate the income and expenses and everything?
Mm-hmm. Yes, I'm going to send you, you guys can maybe do a little bit of advanced work. I'm going to post a link in the chat. It is www.adventuresincre.com, so adventuresincommercialrealestate.com. He has some simple spreadsheets that are all free and some free training videos. And so if you guys want to go watch a couple of training videos and just start to get familiar with it before next week, that would be great. If not, don't worry, we'll go through it. But if you are the kind of person who actually does your homework, this would be a fun project in between for you as well.
Yeah, thanks, Emma. I tried to do it on my own, but I'm kind of new to this, and I got lost, so
yeah.
So I'm definitely looking forward to next week's,
yeah. We'll spend a lot of time going over the same stuff that we looked at tonight, like these investor returns, but we're going to look at the line items and figure out, is this reasonable expenses? Are these reasonable income targets? The purpose of the spreadsheet is making sure that it's accurate, that they know what they're doing. And the second is to just kind of verify that their expenses and their income is reasonable, that their assumptions are reasonable. If they are aggressive assumptions, then these numbers, if they give you the returns, are likely to be too aggressive.
Good, thank you.
All right. Okay, do we have any other questions before we wrap up? Don't have any hands up. Thanks everybody for coming tonight. We will see you again next week. Like I said, if you want to hop to that website and check out some spreadsheets and some training videos, feel free. And then get ready to put on your numbers hat next week, same time, same link. And I'll see you next week. Thank you so much for coming.
Thank you.